Hey there. Let's talk about something that hits different when you're a millennial trying to build wealth: rent. It's not just a monthly bill, it's actually the single biggest leak in your wealth bucket, and the numbers behind it are honestly pretty staggering. If you're renting right now, you're watching your money disappear into someone else's asset, while your own net worth stays practically flat. And the data from 2026 makes this crystal clear. Homeowners in the United States hold on average $430,000 in net worth. Renters, $10,000. That's a difference of $420,000. Homeowners have 43 times more wealth than renters. 43 times. Let that sink in for a second. When you're renting, you're not building equity. You're not accumulating assets. You're paying someone else's mortgage while they build wealth on your dime. Every single month, your rent check goes straight into your landlord's pocket, and it becomes their equity, their asset, their wealth. You get a receipt and the right to stay in the space for another month. That's it. Meanwhile, homeowners are building equity with every payment. When you have a mortgage, a portion of that payment goes toward interest, sure, but the rest, that's going straight into your own equity. Over time, your home appreciates. You build net worth. Your landlord does the same thing, but they're using your rent to do it. This is the fundamental wealth gap that separates renters from homeowners, and it's the reason why so many millennials are stuck in a financial trap. You want to buy a home, you really do, but there's another barrier standing in your way, and it's almost impossible to overcome. It's called the income requirement. Most landlords won't rent to you unless you make 3 to 4 times the monthly rent. So if an apartment costs $2,000 a month, you need to be making between $6,000 and $8,000 a month just to qualify. That's $72,000 to $96,000 a year. But here's the thing. That same income requirement applies to mortgages too, sometimes even stricter. Lenders typically want your housing payment to be no more than 28% of your gross monthly income. So if you're making $6,000 a month, your housing payment can't exceed about $1,680. That seems lower, right? But when you factor in property taxes, insurance, and maintenance, that mortgage payment needs to be significantly lower than your rent to actually work. In many markets, rent is actually higher than what a mortgage would be. You're paying more for the privilege of building zero equity. Let me give you some real numbers from different cities. The average rent for a one-bedroom apartment in Manhattan is around $3,800 a month. In San Francisco, you're looking at around $3,200. Los Angeles is hitting $2,800. Even in mid-sized cities like Denver or Austin, you're paying $1,500 to $2,000 a month for a decent one-bedroom. These aren't small numbers. If you're in New York and you're paying $3,800 in rent, you need to be making between $11,400 and $15,200 a month. That's between $136,000 and $182,000 a year. That's a significant portion of the population right there. And even if you make that much, all that income is going toward rent, not toward a down payment. That's the trap. Your income goes up, your rent goes up with it, and you never actually get ahead. But let's look at this from the landlord's perspective for a second, because understanding their position actually illuminates why this system is so broken. When a landlord owns a rental property, they're not just collecting rent for fun. That rent is an investment return. Let's say a landlord bought a property 10 years ago for $300,000. They put down $100,000 as a down payment and financed $200,000. Their mortgage payment is probably around $1,200 a month. They're charging you $2,500 a month in rent. That's $1,300 a month in pure profit, before expenses. Over 10 years, that property probably appreciated by 30 to 50%, depending on the market. So now it's worth $450,000. The mortgage is down to maybe $150,000 owed. The landlord's net equity in that property is $300,000. They've built $300,000 in wealth, and you've built zero. Your $2,500 a month payments helped them build that equity. You didn't build any of your own, and they're still collecting your rent every month, still building equity, still watching the property appreciate. This is the landlord's equity machine. Your rent is the fuel. Now multiply that across a portfolio. A landlord with 5 properties is collecting maybe $15,000 a month in rent. Even with mortgage payments, property taxes, insurance, and maintenance, they're probably netting $5,000 to $8,000 a month. Over a year, that's $60,000 to $96,000. Over a decade, that's $600,000 to $960,000, plus the equity buildup in all the properties. Meanwhile, you've paid $300,000 in rent over that same decade, and you own nothing. You have no equity, you have no asset, you have no wealth. The system is designed to extract wealth from renters and funnel it to landlords. And millennials are uniquely squeezed by this system because of timing and economics. The housing market crashed in 2008. Many millennials were in their late teens or early 20s. Student loans exploded. The recovery took longer than expected. By the time millennials were ready to buy, prices had skyrocketed again. Interest rates went up, down payments got more expensive, and rent kept pace with it all. So you graduated into a recession, buried yourself in student debt, and then watched the housing market get more and more unaffordable. Renting seemed like the only option. And maybe it was, but while you were renting, you were watching your wealth leak out of your bucket, month after month. Let's talk about what that wealth leak actually costs you over time. Let's say you're a 30-year-old millennial, making $75,000 a year. You're renting a $2,500 a month apartment. You've been renting for 10 years. You've paid $300,000 in rent. What if you'd bought instead? Let's say you'd managed to scrape together a 3% down payment on a $350,000 home. That's $10,500. You'd have a monthly mortgage payment of around $1,800. With property taxes and insurance, you're looking at about $2,200 a month. That's $300 less than your rent. Over 10 years, you'd have paid $264,000 in mortgage payments. You'd have paid down roughly $90,000 of principal. That home would probably be worth $450,000 by now. You'd have $200,000 in equity. Your net worth would have jumped by $200,000. Instead, you have $10,000 in the bank and zero equity. The difference is $190,000. That's not even accounting for the rental increases over the decade. Your rent probably went up too. Maybe it's $3,000 now. Over the next decade, if you kept renting, you'd pay $420,000. If you bought, you'd still have that mortgage, property taxes, and insurance around $2,200 a month, maybe $2,300 after a few increases. You'd pay about $276,000 total, and the home would be worth maybe $550,000. You'd have $300,000 in equity. Over 20 years of renting would have paid about $720,000 and own nothing. Over 20 years of owning, you'd have paid about $540,000 and own a $500,000 asset. The wealth difference after 20 years isn't $200,000. It's more like $450,000. That's the real cost of renting. It's not just the money you don't have, it's the wealth you never built. It's the compound effect of watching your money disappear while someone else's portfolio grows. So why don't more millennials just buy? Well, let's be real. It's hard. That down payment is the killer. Even with a 3% down payment, you need $10,500 liquid cash for a $350,000 home. Add closing costs, and you're probably looking at $15,000 you need to have right now. If you've been renting and paying off student loans, you probably don't have $15,000 sitting around. You might have $5,000, maybe $7,000, if you've been saving aggressively. Coming up with that down payment means not going out to eat for 2 years. It means not taking a vacation. It means every dollar goes into a savings account. And even then, if you're living paycheck to paycheck like so many millennials are, even with a solid income, it feels impossible. The landlord's income requirement of 3 to 4 times rent makes sense from their perspective. But it also creates a massive barrier. If you're making $75,000 a year, you can afford rent up to about $2,250 based on 30% of your income. But landlords want more security, so they require 40% to be safe. You're looking at a maximum of $2,500 in rent. That limits where you can live. In expensive cities, that's not even possible. And if you can't find affordable rent in your city, you're either spending too much of your income on housing, or you're not living there at all. This is why so many millennials are either stuck renting expensive apartments in expensive cities, or forced to move to cheaper markets where jobs are scarce. The system doesn't have a good middle ground. But let's get back to the fundamental truth here. Renting is not an investment. It's an expense. It doesn't build your net worth. It doesn't create equity. It doesn't give you an asset you can tap into later. It just keeps you in a cycle of monthly payments forever. Homeownership, on the other hand, is forced savings. Every mortgage payment builds equity. Every year your home appreciates, your net worth grows. After 30 years, your home is paid off. You own it outright. Your housing costs drop to just taxes and insurance, maybe $500 a month. In retirement, you can downsize, access that equity, and have cash to live on. A renter in retirement is still paying $2,500 a month in rent, with no equity to tap, no asset to leverage. The wealth gap between a homeowner and a renter doesn't just exist during your working years. It compounds in retirement. A homeowner at 65 owns a home worth $500,000 outright. A renter at 65 owns nothing and is still paying $2,500 a month. That's $30,000 a year. Over a 30-year retirement, that's $900,000. The homeowner has $500,000 in assets, plus the luxury of cheap housing. The renter has zero assets and is hemorrhaging money every single month. This is why the data shows what it shows. Homeowners with $430,000 in net worth, renters with $10,000. The gap isn't an accident. It's baked into the system. And millennials, through no fault of your own, got the short end of the stick. You were hit with a recession, student loans, and an inflated housing market all at once. But now you know what's actually happening. Every month you rent, you're making a choice.